Right. First of all, I would like to apologize for delaying you guys. Unfortunately, we had load shedding in the morning, so the revision classes that I was doing in the morning were delayed, and it led us to being delayed also. I'm very, very sorry for that. Right. Our class today will be aiming to cover almost everything that I can expect you to face. And please, we are not necessarily targeting the question as it is. So you will see me here and there. I will be veering off the subject matter so that we can be able to explore some of the other possibilities that can be there in that particular question. Right, so we shall start our class now. I think around 3:30, quarter to 4, we'll take a small break. Right, we'll finish around 5:30 or so. I think I wanted exactly 4 hours, but unfortunately we can't have them now because I'm likely to have another load shedding later today. Otherwise, I wanted at least 4 hours straight. Right, so we'll continue like from now until around quarter to 4. We'll take a small break, 10 to 20 minutes break, or 10 to 15. Then we start again. Then we finish off. We'll start from the beginning of the question, and our aim is to make sure that we do as much as possible. In case there are changes, both of like my timetable has been erratic of load shedding, then we can try to finish it off. But if we are unable to finish it off, you will have to do the rest, and then maybe you can ask me via our phones. Then we can be able to discuss what can happen. Please feel free between now and the date of your exam. I know that you're not writing tomorrow, to ask any questions regarding whatever you will be studying. Please, if it's urgent, you are busy studying, you need to really understand something fast, I urge you to call, because you'd find that WhatsApp usually, because of this exam time, I'll be having a lot of classes. And sometimes you might find that you might ask a question in the morning, then you only get your reply in the evening. But you guys, I know that you are writing. So if you have got something urgent, please call. If you call, I know that there's a pending issue. If I'm doing something, as soon as I finish, I will come back to you so that we can be able to be on the same level. Right. Right. So let's go to the paper so that we can see what is there. Right, we'll start from question 1. Right. It has got 2 parts, part A and part B. Right. According to part A, Home Limited manufactures kitchen equipment for households. The annual financial statements of Home Limited for the year ended 31 May 2021 were presented to the board. for authorization of issue on 31 July 2021. Right. My friends, the dates, they are very, very important here, as we shall see. These dates, our year end is 31 May 2021, and they were authorized for issue on 31 July 2021. That's another aspect that I wanted to cover with you today, but unfortunately, we will just talk about it during this class. This is the period between the year end and the date of authorization of issue that we recognize what we call events after the reporting period according to IS 10. So anything that happens during that period can be considered when we can be considered in the financial statements. And it will depend on various issues that we shall discuss at a later stage. Right. Then the trainee accountant of Home Limited is unsure about the recording of the following transactions in the accounting records of Home Limited for the year ended 31 May 2021 and requires your assistance. Right. Then prepare the journal entries if necessary to account for the unrecorded transactions 1 and 2 above in the accounting records of Home Limited for the year ended 31 May 2021. Clearly indicate in your answer if the item is a statement of financial position or a statement of profit or loss and other comprehensive income. General narrations are not required. Ignore any text and VAT implications. Right. So we'll have our on which date are you writing this one? Which date are you writing your paper?
Friday.
Friday. Hey, so it's still far away. You still have a lot of time to catch up. Right. Okay, thank you so much, guys. I see that it's Friday on the 19th. So you still have a lot of time to shape your distinction. Right. Let's look at these transactions. On 1 May 2021, right? Our year is ending on 31 May. Remember, your year end is very, very, very important. On 1 May 2021, a regular customer of Home Limited ordered a new refrigerator from Home Limited, which was delivered to their central store and to the customer on the same date. So it was delivered on the same date. Remember, according to IFRS 15 revenue, we only recognize revenue when we have fulfilled our performance obligation. So now we delivered that on that date. So we had fulfilled our performance obligations, so we could recognize revenue. This refrigerator is sold at a gross profit of 50% on the cost price. Home Limited uses the perpetual inventory system to account for inventory transactions. The sales agreement, which was signed on 1 May 2021, included the following terms: cash selling price 70,000, trade discount 10,000, annual installment 25,000. The agreed price will be paid in 3 equal annual installments on the following dates: 30 April 2022, 30 April 2023, and 30 April 2024. The discount rate that reflects the customer's credit risk is 12.045% per annum. You may assume that the financing component of this transaction is significant. Right, when they say the financing component is significant, it means that when the price was determined, it included what? It included interest. because of the delayed payment. So interest is not recognized as revenue. It is a separate income item. So we should separate our income from the revenue to end the interest. Just a second. Sorry, there was some noise, so I wanted to check on it. Right, so there's what we call a significant financing component. Right, first of all, let me talk about the trade discount. A trade discount is not recorded in the books of accounts. A trade discount is not recorded in the books of accounts. Right, so when we've got a sale, we should record it net of the trade discount. Right, then number two, they are paying 25,000 per annum. So you have to find the present value of the payments that will be made to so that we can be able to know how much is our revenue. We have to find the present value of the payments that are to be made. Right. So now let us determine that present value. Right. A present value of revenue. Right. We have our sorry, just a second. Right. Our PMT is equal to 25,000. It's a PMT because it's an annual payment. Remember that a PMT is a payment per period. So it's a PMT because it's an annual payment. Right. Our N is equal to 3 because we've got 3 years. We have got 3 years. Right. Then our interest, we use the rate applicable to the particular customer, which reflects the credit risk, which is 12.045%. So that's 12.045%. Then we find our PV. I'm waiting for you.
I'm getting 59,999.
Point what is, does it decimal? You have decimals?
Yes, 0.3800.
So it's 59,999.
Yeah.
Actually, maybe because of the rounding off, actually, maybe it was 60,000 exactly. So if we're given, we're not given, we're just going to say 70,000 minus 10,000, which is the 60,000. Is that right? Right. So that is the revenue. Right. So the rest, was, remember, they are paying 25,000. 25,000 times 75,000. 25,000 times 3, it's 75,000. So the rest, the other 16,000 or 15,000 is interest. So now to record our revenue, we're going to say, this is for the year what? For the year ended 31 May 2021. Right. On the date of the sale, that is on 1 May 2021, we recognize the sale. So on 1 May 2021, right, we have 1 May 2021, we are going to recognize our trade receivables because this is a sale on credit, SFP, which is 59,999. Then we credit revenue, 59,999. Right. Revenue is income, is P&L. Remember that if it's an income or expense item, we use P&L. If it's an asset, liability, or equity, we use SFP. But for equity, you have an option to either use SFP or statement of changes in equity. Right. Then on that date, since they are applying the perpetual inventory system, as long as the entity is applying the perpetual inventory system, you also have to recognize your cost of sales and your inventory movement. Right. So we know that the cash selling price was 70, and we know that the profit was 50% on cost price. So to account for our cost of sales, we'll debit our cost of sales with P&L. Then we'd say 70,000 times 50. Sorry, times 100 divided by 150. But if the profit was on selling price, we're just going to multiply by 50%. We're just going to say 100 minus the gross profit, we get a 50%, then we multiply by 50%. But because the gross profit is on cost, that's why we're multiplying by 100 and dividing by 150. What do we get?
Four, 6, 6, 6, 7.
6.
4, 6.
Right. Then we credit inventory. Any questions on the transaction on 1 May? Right. Then on 31 May, that is our year end. Remember that our year is ending on the 31 May 2021. We then recognize the portion of interest. So every period will be recognizing interest. Then we debit our trade receivables. Because remember, payment will only start in 2022 with the interest to increase because the data is not yet paid. That will be 59,999 times the interest rate, which is 12.045%, times we know that it's the interest is for 1 month because the sale happened on 1 May. So we'll be accruing the interest. What do we get?
$602.
602. Then we credit finance income. Any questions? Right. So that's it on the first transaction, the number 1 transaction. Any questions on number 1? Right, I move on to number 2. A major competitor of Home Limited announced a significant decrease in the selling price of its food processors during June 2021. Remember that our year is ending in May. So this happened in June. And June was before 31 July 2021, the date of authorization. So we call it an event after the reporting period. This is an event after the reporting period. So a major competitor of Home Limited announced a significant decrease in the selling price of its food processors during June 2021. The competitor was able to do this because of its ongoing investment in new technology. Included in the inventory in the draft statement of financial position of Home Limited on 31 May 2021 is their own brand of food processors manufactured at a cost of 230,000. However, due to the competitor's price reduction, the net realizable value of the inventory of food processors of Home Limited on 31 May is 195,000. Right. Right. An event after the reporting period can either be an adjusting or a non-adjusting event. An event after the reporting period can either be an adjusting or a non-adjusting event. Right. It is an adjusting event if it happens after year end. We are just receiving information that reflects circumstances that existed at the reporting date. Right. So as long as it reflects circumstances that existed at the reporting date, then it's an adjusting event. But if it reflects circumstances that arose after the reporting date, then we call it a non-adjusting event. And a non-adjusting event, we don't correct our financial statements, but rather we just disclose it in the notes to the financial statement. Right. Now we find that in June, this guy announced the decrease in the selling price of its food processors. But to announce this was because of their they have investment in technology. The fact that they announced it in June, it might reflect circumstances. It is reasonable to assume that these were circumstances that were there at the reporting date, but we only knew about it after the reporting date. So it will be taken as an adjusting event. Because remember, an announcement, usually it's you are now going public of something that was already there. So it can be reasonable enough to assume that these circumstances existed at the reporting date. So we'll take it as an adjusting event. So we have to adjust our inventory. Now our inventory, it was recorded at 230, but now its net realizable value is 195,000. Now, according to IS2, inventory should be recorded at the lower of cost and net realizable value. So we have to write down this inventory from 230 to 195,000. So to do that, it would say 31, or it's 231, so there's no need to change the date. We'll debit inventory, write down which is an expense, which is P&L, which will be 230,000 minus 195,000. Of which we get, how much do you get? Is it 35,000?
Yes.
Then we credit, because our inventory is reducing, we credit the inventory. It's an asset. Remember, an asset reduces on the credit side. These are our general entries. Any questions? Right. So if we don't have any questions, then we'll go to the next question. Part B. The annual financial statements of Imishini Limited, a retailer and manufacturer of farming tractors and equipment for the year ended 31 August 2015 were presented to the Board of Directors for authorization for issue on 15 September 2021. So this is 31 August 2021, the year end. Right, let's go to the required. With reference to additional information 1, discuss with the reasons how inventory will be classified in the statement of financial position of Imishini in terms of IAS 1 presentation of financial statements. All right, information 1. After the draft financial statements of Imishini Limited for the year ended 31 August 2021 had been prepared, the directors decided to change the current inventory valuation method to ensure more reliable and relevant cost information of the effect of the inventory movement on the company's profit. As a result, the directors decided to change the accounting policy in respect of the valuation of inventory from the weighted average method to the first in, first out method. Imishini Limited uses the perpetual inventory system. The SA Revenue Service will not reopen the previous year's tax assessments. Right. So the issue is, how are we going to present this inventory? Remember that a inventory is an asset. Right. Then the issue is, under which category are we going to record that asset? Right. So now it can either be a non-current asset or a current asset. Right. So now we know that according to IAS 1, an entity shall classify as current shall classify in assets when, number 1, it expects to realize the assets. When we're saying to realize the asset, that means to get the cash from the asset, or intends to sell or consume it in its normal operating cycle. Right. It holds the assets primarily for the purpose of trading. It expects to realize assets within 12 months. After the reporting period. Or the asset is cash or cash equivalent. Unless the asset is restricted from being exchanged or used to settle a liability. For at least 12 months. after the reporting period. Right. So this is the definition of a current asset. I'm limiting my discussion to current assets because I know that inventory is under current assets. With these types of marks, there is no need for us to go and describe the non-current assets and everything. You just look at the marks, but if the marks were main, we're also going to say an asset can be classified as either current or non-current. Right. So we're saying inventory is either consumed or sold within a business its normal operating cycle. Right. So I think as such, inventory should be classified as a current asset. Right. We're saying and sell is normally expected within 12 months. So because of that, we classify our inventory as a current asset. So actually, because they were only about 3.5 marks, you can even leave the other things about cash. You can just say one of the definitions of a current asset according to IS1 is that it should be expected. You can just go on 1, number 2, and number 3, which mainly touch on inventory. You can also mention that maybe the inventory is primarily held by Emission Limited for trading. So that's why. So you have to link the theory to the application on the question. Any questions? Right. So let's move on. Calculate the allocation. Okay, with reference to additional information 2, answer the following. Identify the performance obligations of emission in terms of the contract for the sale of the tractor to Bonberry Farm. Right. What are performance obligations? Performance obligations are those things that the business is expected to fulfill to the customer because of the contract. What is it that emission is expected to do in that contract? Right. So what are the obligations that lie on emission's hands? So if we go to number 2, on 15 May 2021, Emission Limited introduced a new range of tractors. On 1 June 2021, Emission Limited sold one tractor with a 15,000 kilometer service plan for 252,000 cash to Bonberry Farm. Emission Limited sells the same tractors without a service plan for a standalone price of 240,000. A customer can purchase a 15,000 kilometer service plan for the same tractor on a standalone basis for 25,000. All tractors have to be serviced every 5,000 kilometers. Emission Limited uses labor hours expended to perform a service of a tractor to measure their progress towards complete satisfaction of this performance obligation. The labor hours spent on a 15,000 kilometer service plan are as follows. Right, then we're told that on 31 August 2021, Emission Limited performed the 5,000 kilometer service of the tractor of Bonberry Farm. Right, my friends, there are 2 things that Emission is expected to deliver here. Number 1, they're expected to deliver the tractor. Number two, they are expected to perform the service. So those are the two performance obligations. Right. So we can say number B. Contract with Bonberry Farm. One, the performance obligations. So we have got the tractor. That means delivering the tractor. And performing service when due on the tractors when due. Any questions? So those are our two performance obligations. So performance obligation is simply what you are expected to fulfill. Right. So let's go to the next question. Calculate the allocation of the consideration of 252 from Bonberry for each performance obligation. Right. The complication to allocate this transaction comes from the following. Right. Number one, the tractor on its own is 240. And the service on its own is 25. So these two, the total price is 265. But because you're acquiring it on one time, like they call it selling a bundle of products. I think we have seen in ShopRite, whereby they tell you that if you buy sugar, mealie meal, and stuff like that, you can buy them at a combined price, which is cheaper than if you buy them separately. So this 252 now has to be allocated. So that means for the tractor and service, it's no longer 240 and 25. So we have to find out how much of that 252 will be allocated to the tractor and how much will be allocated to the service. The allocation is done in proportion to the standalone selling price. So we allocate according to the standalone selling price. So how we're going to allocate would say allocation of transaction price. Right. We'll have our performance obligation. Standalone selling price. Calculation. Sorry, I think we need to percentage. Calculation. Allocation. Right. We have got the tractor. We have service plan. Right. Our tractor, the standalone price. When we say standalone price, that means the price that it can be sold on its own is 240, and the service is 25. So I'd say 240 and 25. Then the separate prices are 265,000. Right. Then to calculate our percentage, we can just say this 240 divided by the total times 100. Right. So this is our calculation. So that means the tractor will get 90.57% of the combined price, and the service plan will get 9.43% of the service of the combined price. The combined price is 252,000. So we're going to say 90.57% multiplied by 252,000. What do we get?
$228,236.
Thank you, guys. What do we get?
$23764.
So that means of these 252,228, although the tractor costs 240, they are going to say no, in this deal, the tractor was for 228,236. And revenue for the tractor will be recognized immediately because we have a difference of obligations that are fulfilled at a point in time. Providing a tractor is fulfilled at a point in time. The day that we deliver the tractor, we've satisfied the obligation. But the service is fulfilled over time. Why? Because we'll do a service when the tractor is gone for 5,000 kilometers. Then after that, for another 5,000 kilometers, we do another service. So it will be fulfilled over time. So the service plan, we don't recognize the revenue now. We only recognize when the service is fulfilled. So in the meantime, the 228 will be taken as revenue and the 23 will be taken as a liability. Any questions? Right, if we don't have any questions, we'll go to the next one. Then number 3, discuss with reasons if revenue from the service plan should be recognized over time in the accounting records. I think I just explained that. That means the service is performed after every 5,000 kilometers. And is not done at one specific moment. As such, we consider the service to be fulfilled over time. Any questions? All right. We go to the next one. Prepare all the necessary journal entries to correctly record the transaction in additional information 2 and 3 in the accounting records of Emission Limited for the year ended 31 August 2021. Right. So we're going to say right. So we are required to do 2 and 3. So on number 2, we've just done the calculations there. Was it okay? Let me just check. Was it for cash or on credit? It was cash, for cash. I'll tell you why I was checking there. If it's cash, we'll debit bank. If it's credit, we're going to debit just like the other one, trade receivable. So that's why we have to check. Then we credit for the tractor. We credit revenue. Why? Because we've already delivered the tractor. We've fulfilled the performance obligation in terms of IFRS 15. So we can recognize the revenue. Then we recognize a contract liability for the service plan, which is you take it as a liability because we have received the money, but we've not yet done the service. That is 23,764. I'm taking my amounts from here. Right. Then we are told that on 31 August, Emission Limited performed the 5,000 service plan. Remember that our year is ending on 31 August. So they did the 5,000 service plan. Right. We know that the 5,000 service plan will take three hours. And the total for all the services is 10 hours. So the reasonable basis, they can give you a policy, but if we don't have, we can just assume that the reasonable basis is to use the hours. So since they've done the service for 3 hours, we'll use the hours. Right. Okay, it's written. Emission Limited uses labor hours expended to perform a service of a tractor to measure their progress towards complete satisfaction of this performance. So they are using labor hours. So allocate according to the labor hours. Sometimes they could use the kilometers. So we'd say it's 3, they've done 3 out of 10. So we'd recognize the revenue for that. So debit the contract liability. No longer have a liability for the 5,000 plan. That is not the full amount, but 23,764 multiplied by the 3 hours that we've spent divided by the total hours, which is 10. What do you guess?
Seven, 1, 2, 9.
Right. Then we credit revenue. You can even specify that service plan, but there's no need. We can just say revenue. So that is our general entry for number 2. Thank you, guys. Any questions there? Then we do number 3. They said also number 3. Right. This one here. Due to the introduction of the new range of tractors above, the spray painting equipment leased by Imishini Limited were inadequate to spray all the tractors owned by Imishini Limited. Subsequently, the directors decided to terminate the operating lease agreement for the spray painting equipment. The current operating lease agreement for the lease of the spray painting equipment expires on 31 August 2022. The spray painting equipment leased were determined to be low value assets. The current operating lease agreement stipulates that early termination will result in a penalty of 105,000. The rent, according to the operating lease agreement, amounts to 7,750 per month payable in arrears. All the lease payments for the year ended 31 August 2021 have been paid to date. Right, if you are likely to face a penalty, which is included in a clause in an agreement for breaching a contract, you have to create a provision which you call the provision for onerous contract. So you create a provision for onerous contract, right? The provision will be created at the most likely amount, which is the lesser of the amount you have to pay to fulfill the contract and the penalty, right? So if we can check here, our penalty is 105,000. Right, penalty is equal to 105,000. How about if we pay rent? Rent is equal to 7,750 per month. So it will be 7,750 multiplied by 12, which is equal to what? Thank you. Right. So our rent is 93,000. So our provision will be created for 93, not 105, the lower. So we're saying use lower amount. Why? Because every reasonable person, if the penalty is 105, what will you do? I'll just move out and say, okay, I'm still in, although you're not using, and then you pay the rent instead of paying the penalty of 105. So use the lower amount. So instead, we're going to debit the lease penalty, which is an expense, 93,000. Then we credit provision for onerous contract, which is 93,000. So you use the lower of the two. Any questions? Right. So that's it on this. Number D, disclose additional information 1 and 4 in the notes to the annual financial statements of Imishini Limited for the year ended 31 August 2021 according to the requirements of IAS 8. Right. extracts of the notes to the financial statements. Of IMSHINI Limited for the year ended 31 August 2021. Change in accounting policy. Remember, number one is about the change in accounting policy, which we read already. That was, remember that after the draft financial statements, IMSHINI decided to change the inventory valuation method to ensure more reliable and relevant cost information to the effect of inventory movement in the company's profit. As a result, the directors decided to change the inventory money, the accounting policy in respect of the valuation of inventory from the weighted average method to the first in, first out method. IMSHINI, they said what IMSHINI Limited uses the perpetual inventory system. The SA Revenue Service will not reopen the previous year's tax assessments, and they will not accept the new inventory valuation method. So that's a change in accounting policy. Right. First of all, you write a brief description. Right. You can say during the year, the company changed its accounting policy in respect of the valuation of inventory from the weighted average method to the first in, first out method. Right. Then you have to write the reason why. So here we've described the change. Then you have to write the reason why, because they wanted to ensure a more reliable and relevant cost information of the effect of inventory. So you'll be given that reason. All right. So you can then say this change was necessary to ensure more reliable and relevant cost information of the effect of inventory. I'm just taking from the question paper, it's given. Movement on the company's profits. Right. Then this one is a standard statement. The change in policy was accounted for retrospectively. And comparative amounts have been appropriately restated. The effect of this change is as follows. Right, my friends, if it was not possible to account for it retrospectively, you have to state why. Remember, according to IS 8, a change in accounting estimate is applied retrospectively. What does that mean when we say we apply it retrospectively? It means we also have to adjust all the figures, related figures for the previous years, which affect the comparative financial statements. Right, so we're supposed to adjust that. If it was not possible, because they can tell you that, for example, that they couldn't adjust the figures for 2019. Then if it happens like that, then you have to adjust accordingly. Just a second. Right. So we'll have our 3 years. (2021, 2020, 2019). First of all, we start with the effect on cost of sales. The effect on cost of sales will only show for the previous 2 years, because the financial statements will only have the cost of sales for the previous 2 years, 2020 and 2021. Right. So we'll have 2021 and 2020. We don't mind about 2019 because the comparative statements, remember, will be only for 2 years. Will only be for 2 years. That is 2021 and 2020. So the cost of sales will only have for 2021 and 2020. Right. Then we check what happened to our opening inventory and the effect on our closing inventory. Right. If you see, they changed from weighted average to first in, first out. So they were moving from this figure to this figure. If you can see, your inventory values increased. They increased the inventory values. So there will be the opening increase in opening inventory. Right. The opening inventory for 2021 will be the inventory for 2020. The opening inventory for 2020 will be for 2019. So when we're talking about opening inventory, under 2021, we'll be talking about the 2020 figure. Under 2020, we'll be talking about the 2019 figure. Why? Because our inventory for last year is the opening for this year. So we're going to say on 2021, we're going to say 599,000 minus 575520. And on 2022, we're going to say, on 2020, sorry, 553,000 minus 537,000. Right, what do we get? Okay, thank you. 23,480 and 16,000. Thank you so much. 23,480 and 16,000. Right, these ones will increase cost of sales. Remember, when your opening inventory increases, your cost of sales will also increase. When your opening inventory increases, your cost of sales will also increase. Right. So that will be an increase. Then we have got our increase in closing inventory. Now for 2022-21, it will be going on 2021. Right. So we're going to say it's 635,520 minus 593,200. What do you get?
$42320.
42320. And for 2020, there's no need to calculate. We calculated it already. It will be the what? The 23,480. Right. So then we'll have our, if you can see, our cost of sales is decreasing. Right. You know that an increase in opening inventory increases cost of sales, but an increase in closing inventory reduces cost of sales. So here, overall, there's a decrease in closing inventory. Any questions there on the effect? So you have to check whether you're opening, right? If your opening inventory decreases because of the change, the cost of sales will go down. And if your closing inventory decreases, the cost of sales will go up. Right, that effect then will come with it here. We have got decrease in cost of sales, which is 18,840 and 748. Right. We don't put anything on the 2019. Why? There is no comparative cost of sales in the financial statements for 2019. Our cost of sales will only be there for this year and last year. Right. Then you record the effect on tax. Right. When your cost of sales is an expense, when expenses reduce, your profit will go up. And when your profits go up, your tax will go up. So there'll be an increase in tax. But you have to know, is it current tax or deferred tax? It is current tax if SARS agree to take into account the change. And it is deferred tax if SARS do not accept to take into account the new method. So you should always check. It's very important to check that. Now we're told that the SA Revenue Service will not reopen the previous year. That means for 2020 and 2019, they are not going to accept. So we'll use deferred tax. And they will not accept the new inventory method. That means even for this year, they are not accepting. So we should use deferred tax on all the 3 years. But if they said they will not reopen but accept, that means for this year, it was going to be current tax. Or if they say they will reopen and accept, that means for all the years, it will be current tax. And another thing, you have to be very careful. because they can change the tax rate, you should check the share tax. Here we're told that the SA normal tax rate has remained unchanged at 28%. So we're going to say a increase in deferred tax expense. So it's deferred tax because SARS will not agree, so there will be a temporary difference. So that will be 18,840 multiplied by 28%. Then we have 7,480 multiplied by 28%. What do you get? So please, the top part, whether it's an increase or decrease, you just put it as a positive. Then the tax effect is the one that you put as a negative. The word decrease will tell them that it will tell the users that there's a decrease in the cost of sales there. Right, what do you get?
5275.
5275 and
2094.
2094. Then we'll have our increase in profit. There's an increase in profit because our expenses are reducing. If our cost of sales had been increasing, there was going to be a decrease in tax and also a decrease in profit. That is the effect on the P&L part. Then you have to show also the effect on the SFP part. Right? Remember, there's an increase in inventory for all the years. Right? In 2020, it's a standalone now. That is the 42,320. In 2020, 23,480. We calculated those figures when we were doing the 16,000. These figures that we calculated here. Here now on the inventory, we're just saying on 2021, we just take the difference between these two. On 2020, the difference between the two, that is for that year. On 2019, the same thing. Right. Then since SARS did not accept, then there will be what? Increase in deferred tax liability. If our tax had gone down, our inventory had gone down, then it was going to be decrease in deferred tax liability also. Right, so that would be 42,320 times 28%, then 23,480 times 28%, then 16,000 times 28%. What do you get?
The first one, it's 11,850.
Next.
$6,574.
Next.
$4,480.
Then we get our increase in equity. Right, then we have our increase in retained earnings. At beginning of here. Right, the 11,520 will increase the retained earnings in. Remember, whatever increases the profits in 2019 will also affect the retained earnings for 2020. Then the one for 2020 will also affect the retained earnings for 2021. Any questions? So that's the note for inventory. Right. They also asked us to disclose number 4. On number 4, they said during the current financial year, the accountant of Imshini Limited found invoice 51612 dated 25 August 2020 to have been incorrectly recorded. A wheat planter machine with a selling price of 65,000 sold to the, that is for this one is for 2020. Remember that we're in 2021 now. To the Gauteng Agricultural Cooperative was incorrectly recorded as sales with a selling price of 6,500 excluding VAT. So although it was bought for 65,000, it was incorrectly recorded as sales. The wheat planter machine was delivered to the Gauteng Agricultural Cooperative on 25 August 2020. On 31 August 2021, the balance on this sales invoice was still due to Imshini Limited. The effect of the incorrectly recorded invoice is considered material. The South African Revenue Service has agreed to reopen the prior year's tax assessment in respect of this matter. Imshini Limited is a registered VAT vendor. So they sold equipment. This is a sale. So the error was they recorded it at 65,000 instead of recording it at 6,500. Right. So we have to say, since the error happened in 2020, the note, we call it the prior period error. So we can say correction of incorrect recording of sales in 2020 financial year. The effects of the correction on the previous year financial statements. Is as follows. We have 2020, sorry. Right, we have to increase our sales. Right, I want you to check here. The sales were from 65, but they wrongly recorded them at 6,500. So we have to increase our sales by 65,000 minus 6,500. What do we get? Thank you so much. 58,500. Right. Then we record the effect on what? On text. Right. Let's remember that SARS have agreed to reopen. So it will be current text. So then we are going to say Sorry, just again. Increase in current tax expense. $58,500 times 28%. But if SARS had not agreed to reopen, it was going to be deferred tax. What do you get? $16,380. So negative 16,380. Then we get our increase in profit. Right. Then we've got increase in trades and other receivables. Then we have increase in current tax liability. Again, it was going to be deferred tax if SARS had not agreed to reopen. Then we get our increase in equity. Right. That's the prior period error. So it's a prior period because the error it happened in the 2020 financial year. Any questions? Right. Then calculate the deferred tax balance in the statement of financial position of eMachine Limited. Right. Then we'll do number E. Calculation of deferred tax balance of eMachine Limited for the year ended 31 August 2021. Right, we just have to look out for assets and liabilities for which the carrying amount and the tax base are different. That means the SARS and us are recording the amount differently. Right, we have carrying amount, temporary tax base, temporary difference, then deferred tax at 28%. Right. Let's start from the top. On number one, there will be deferred tax because SARS said they will not reopen and they will not accept. Because of that, SARS will still record this inventory at 593 whilst we are recording it at 635. So there will be temporary difference. So the carrying amount will be 635. $635,000. And the tax base will be 593,200. Then the temporary difference would be the difference between the two figures, 41,800. Then can we find your deferred tax at 28%? So this 6685520. Sorry about that. Can you multiply this 42,320 by 28%? I think we did that already. 11,850. It's a deferred tax liability, right? When the carrying amount of an asset is more than the tax base, there's a deferred tax liability. That's why this one is negative. When the carrying amount of an asset is more than the tax base, there's a deferred tax liability. And when the carrying amount of an asset is more, when the carrying amount is more than the tax base, that's when we've got the tax base deferred tax liability. Like here, the carrying amount is more than the tax base. If it's the opposite, that is the tax base is more than the carrying amount, it will be a deferred tax asset. That is for an asset. Then for a liability, it's the opposite. I think you will see it on number 2. Remember, on number 2, we have a contract liability relating to the service plan. That contract liability is not recognized by SARS because SARS, they will recognize the whole 252,000 as your revenue in the financial statements. So they will not have any contract liability. So we're going to have a contract liability, but the contract liability is not the full service plan. My friends, our contract liability would be equal to this amount here, the 23,764 minus the 27,129 that we recognize. So it's the 23,764 minus 7,129. So let's say 23,764 minus 7,129, which is the revenue for the 5,000 kilometers, which was recognized. What do we get? Right, 16,635. The tax base will always be 0 for this. Then can you find 28%? Oh, sorry, the temporary difference will be 16,635. Then can you multiply by 28%?
Four, 658.
Thank you. So you know that our assets will be here. That will be future deductibles or tax benefits. And here they will reduce our tax burden. That's why they come here. Because these assets, they reduce tax burden, whilst liabilities, they increase tax burden in future. Right, then we also have, on number 3, there's that provision for onerous contract. SARS does not recognize these provisions. So we'll have a provision for onerous contracts. We calculated it. 93,000. Tax base will be 0. Most provisions, except the allowance for credit losses, are not recognized by SARS. So can you multiply by 20%? This is also a liability, so it will result in a deferred tax asset because the carrying amount is more than the tax base. Thank you so much. 26,040. On number 5, there will not be any deferred tax because SARS have agreed to reopen. And anyway, it was for last year. Right. And since we're agreeing, so there will not be any deferred tax consequences. So that will be it on this one. Then we add up to find what we're getting. So it's an asset. As you can see, you use this to get to check if it's an asset. If it's positive, that's an asset. So there's a deferred tax asset. If it was negative, it was going to be a liability. That's our defective. Any questions? Right. If we don't have any questions, my time is 12 minutes to 4. So can we take a break until 4 o'clock? Can we take a break until 4 o'clock? Then we'll do some of the questions that follow. Thank you so much, and God bless you richly. So we'll continue in a few minutes. I'll pause the recording so you don't have to use a new link. I'll just pause the recording, and you can just we'll now go to question 2. On question 2, I will not deal with multiple choice. I will only deal with part A. I will try to finish it if our power can allow us. We're still okay at the moment. I'm not very sure what will happen later. Right. Shosho Limited is a company specializing in manufacturing and distribution of household geysers. Right. Discuss with reasons if the insurance liability loss in additional information. 1.2 is liability in the statement of financial position for the financial year ended 30 June 2021 according to the definition of a liability. Right. In terms of the conceptual framework, right. We're saying a liability is a present obligation arising from past events. Settlement of which will result in an outflow of economic benefits. So you have to check if that part that they are asking about manages to meet all those needs, all that criteria. All right. So if we go back, it's 1.2. The financial director is here of Shosho Limited cancelled the insurance policy with effect from 1 July 2020. Right. Remember that our year ending is 30 June 2021. And Shosho Limited will in future self-insure. This decision was made due to the fact that Shosho Limited had never instituted a claim against the insurance company. In future, instead of paying the insurance policy premiums of 7,000 per month, an insurance liability loss of 84,000 was created. In the accounting records of Shosho Limited. Right. Now, the issue is we have to check, is there an obligation which will arise from this scenario that we are talking about? We have to check if there is an obligation. Then after checking if there is an obligation, is it arising from past events? and we have to check the settlement. Would there be an outflow of economic resources upon settlement of the obligation? Right. These guys, they are expecting an unfortunate situation in future, which might arise because of losses. In the past, they were settling these losses through insurance, right? Now, the self-insurance just a second. Right. Now, when we say there's a self-insurance, the self-insurance results in an obligation to settle the loss. A past event is the existence of the assets or resources that are insured. In case of loss, there will be an outflow of economic resources. Since all criteria is met, a provision should be, or a liability exists, sorry. And a provision can be recognized. By self-insuring, that means you are the ones who are going to cover for that loss. Right. Then number B, prepare all the necessary journal entries to correctly record the transaction in additional information 2 in the accounting records of Social Limited for the year ended 30 June 2021. Your answer must comply with the requirements of International Financial Reporting Standards. Right, number 2. The following transactions has not yet been recorded in the accounting records of Social Limited for the financial year ended 30 June 2021. 2.1. Social Limited sold 20 gas geysers to 4all Limited, a long-standing customers for 4,200 each on 1 May 2021 for cash. Remember that our year end is 30 June 2021. Right. For all intents, using these gas geysers in a community project where they plan to build homes for the community. For all is uncertain if they will be able to install all 20 gas geysers, as their funding may not be sufficient for the entire project. Unused gas geysers may be retained if they are in good condition and in the original packaging before 15 July 2021. Using expected values, Shosho Limited estimates that for all Limited will return 4 gas geysers. This estimate is not constrained, as it is highly probable that it will not lead to a significant reversal of the revenue in future. For all Limited did not return any geysers on or before 30 June 2021. You may assume that the cost of sales for transaction 2.1 above has been correctly recorded in the accounting records of Shosho Limited for the year ended 30 June 2021. Right now, there are 20 geysers sold, but 4 of the geysers may be returned. So when there is a variable we call it a variable consideration, whereby the value of the sales is not certain, is dependent on particular circumstances. They may end up using all the 20, or they can use less. So you find the expected value of the sales. That's what you will recognize. So in this case, the cost of sales was correctly recorded. So we're going to debit we have to first find out, was that paid for or not? Right. This way for cash, so we debit bank. Our bank, SFP, it will be 4,200 multiplied by 20. What do we get? I think that's 84,000 if I'm not mistaken. Then we credit our revenue. Thank you so much. Our revenue will only recognize the 16 that are likely not to be returned, which is 4,200 times 16. My 16 is coming from 20 minus 4, because they said 4 are likely to be returned. What do we get? Thank you. 67,200. Right. Then we credit our contract liability for the other 4. I think we get 16,800. That's our general end. Then if the 15th of July arises, comes up and there is no return, then we will recognize the revenue for the other 4. Right. So that's it. If the cost of sales had not been recorded, we're going to debit cost of sales with the cost of the 16 geysers. Then debit right of return assets with the other 4. Then we credit inventory with the 20. Then on the day that, if the 15th, on the 15th of July, if nothing is returned, then we'll then debit our cost of sales and credit right of return. Right. Then on 15 July 2021, the directors declared a dividend of 15 cents per share for the year ended 30 June 2021. The dividends as well as the dividend tax were paid on 2 July 2021. Remember, we're doing these general entries on 30 June 2021 before the payment of the dividend. The issued share capital of Shosho Limited consists of 100,000 ordinary shares of R250 each. You may assume that none of the beneficial owners are exempt from dividend tax. Right. Then we'll debit our dividends paid. Dividends. That would be, we can say this can be statement of changes in equity. Right, they said our shares are 100,000. And our dividends, 15 cents per share. So we get 15,000. Then we credit dividends payable. Right, the dividends payable is what, because we have not yet paid, remember that they only paid in July. Our dividends payable would be 15,000 times 80%. Because the other 20%, since they are not exempt, right? You should know that on individuals, the dividend will not be exempt. But for companies, if we've got shareholders who are companies, then they will be exempt from dividend tax. Right, what do we get? $12,000. Then the other 20% will be payable to SARS. Dividends tax payable. Because we are required to withhold that tax. It will be the 15,000 and 20%. Right, that's our dividend. Any questions? Our next, calculate the correct profit before tax in the statement of profit or loss and other comprehensive income. Right. If they say calculate the correct profit before tax, that means it's already given. But there are some things that were made, that there were errors and omissions. So you only have to take into account the and adjust for any errors and omissions that took place. Right. So we have our profit before tax. There was this one here. So we have to start with from that one. Provisional profit before tax. Which is 1269 660. Right. Then we check for any errors and omissions, starting from the beginning. Right, whilst we are reading, we will not read again the whole thing. The income received from Kenya is not taxable in South Africa in terms of a double taxation agreement. Shosho Limited paid foreign taxes of 60,000 on this income. Right, this income is already included here. If you can see here, it's already included here. Then number 1.2, the financial director of Shosho Limited cancelled the insurance policy with effect from 1 July. Okay, we read that one. That is this provision. In number 1.3, the trust fines are not taxable. They are already included. Right. Number 2, right, we already did it. Right, these were not yet recorded. So we have to record them. So we have to record the revenue of the 16 geysers that we did the general entry. The dividends do not go in the statement of profit or loss. Dividends paid are not included. So we just have to record the revenue. So that is the revenue, which is only the 67,200. Right, for the 16 geysers. Then number 3, the SA Revenue Service allows 25% of allowance for credit losses. In previous years, right, our credit losses has been included here. So it's sorted. We have it already. So no need to worry. Property, plant and equipment. The following schedule relates to the assets of Shosho Limited before taking into account the additional information 4.2. So we have to see 4.2 might have new things then. Right, sale of vehicles. On 30 June 2021, which was during at the end of the financial year, Shosho Limited sold a vehicle for 270,000. It was originally acquired and available for use as intended by management on 1 July 2019 at a cost of 260,000. On the date of the sale, the accumulated depreciation of this vehicle amounted to 104,000. Only the amount received for the motor vehicle sold was recorded in the accounting records of Shosho Limited for the year ended 30 June 2021. The schedule above was prepared before the sale of the vehicle was taken into account. During the current financial year, Shosho Limited did not purchase or sell any other assets. Right, so that means we have this sale of vehicle. They were not supposed to include the 270. They were supposed to include the profit on the sale. Right, so we would say the proceeds from sale of vehicle is 270,000. We have to subtract that. In its place, we include the profit on sale of vehicle, which would be the selling price 270,000 minus the carrying amount. Right, our carrying amount would be the cost which was 260 and the accumulated depreciation which was 104,000. So I would say less 260,000 minus 104,000. What do we get? So that's what was supposed to be included, not the 270. Right. Then sale of geysers with the warranty. Shosho Limited sells geysers with a 6-month warranty against all manufacturing defects, excluding normal wear and tear. The 6-month warranty cannot be purchased separately. The provision for warranty costs amounting to 106,000 for the current year has already been recorded in the accounting records. So it was already recorded. So I don't think there's any problem there. Then the directors decided at a recent board meeting that the current warranty provision does not give a reliable estimate of the future warranty costs due to newly developed components that makes it possible to repair the geysers instead of replacing it. The provision for warranty cost represents the cost of replace the geysers and is currently based on the following assumption. 10% of all the geysers sold will have defects that have to be replaced. Right. Then now they are saying the results of this analysis indicate that the geysers are retained for the following reasons. 60% of all warranty claims relate to major defects that require replacement. Right. Then 40% of the warranty claims relate to minor defects that can be repaired using newly developed components. Repair costs relating to the minor defects of the geysers are estimated to be 20% of the original cost to completely replace the geysers. Right. So the whole provision it was all about replacing. But now they are saying 40% will no longer have to be replaced. They now have to be what? There will be repairs. Right. Actual warranty costs paid for the year ended amounted to were given. Actual warranty costs and reversals of warranty are debited against the provision. Okay, this is about the policy. So the issue is we have to reduce our provision for warranty. It has to be reduced. That means the amount that they provided, which is was it 106,000? 106,000 is to be reduced. On about 40% of the amount, we have to take out 80%. Because it will only the cost will be 80%, 20%, sorry. So say the provision warranty cost right would say 106,000 times 40%. Only the we're taking out only the portion that is to do with minor costs. Then multiplied by 80%. The 80% is the reduction in cost. Remember, they said that they will only be 20%. So what do we get? $33,920. Thank you, guys. So that's $33,920. Our profits will go up when we reduce our provision for warranty. Right. Then claim against a Shosho Limited. On 15 May 2021, Drill Limited instituted a claim of $220,000 against Shosho Limited for allegedly selling defective givers to Drill Limited. At year end on 30 June 2021, the legal advisors of Shosho Limited are of the opinion that it is probable that Shosho Limited will not be found liable for the claim due to the fact that all the geysers are subject to stringent quality inspection before being sold. So, right, it is not probable that will be found liable. So this would be a contingent liability. If it was probable, it was going to be a provision. So a provision we're going to adjust the financial statements. So this one is a contingent liability because it is not probable that we are going to pay. So because of that, we are not going to adjust our financial statements. Right, number 7 talks about taxation. So that's it. Then we calculate our corrected profits. Corrected profits for the year. Right. Any question? Right, then the next stage, calculate the deferred tax. Calculation of deferred tax as at 30 June 2021. Right, you have to check if you are required to calculate for both years. It's only for 30 June 2021. So we have to check all assets and liabilities for which there will be a difference. Right, number one, at the foreign income, there's nothing. Number two, this provision for insurance policy, this 84,000, there will be a deferred tax consequences because SARS are not going to recognize this provision. So we'll have provision for insurance liability loss. They will have a carrying amount of 84,000, tax base of 0. Then our temporary difference 84,000. There will be a deferred tax asset because this one it's a liability. When a liability is carrying amount is more than the tax base, there's deferred tax asset. Right, we have to check our tax rate. Please, for exams, check your tax rate. It changed from 29 to 28. It's now 28. So we'll have, what do we get here? $23,520. Right. Then we'll have on 2.1, we have got contract liability. As SARS, they will take the 20 geysers as part of your revenue. And if they are retained, that's when they will account for the return. So that contract liability will not be recognized by SARS. So we'll have contract liability. We have already calculated it. It's 16,800. Can you find 28%? Thank you. 4704. On the dividends, there's nothing. Then on the credit losses, your allowance for credit losses, which we created of 66,000, which was created, there will be a deferred tax consequence. We'll have our allowance for credit losses. Our tax base will be 25%. remember that they said that SARS allows only 25% of the allowance. So we'll have allowance for credit losses. $66,000 multiplied by 25%.
$16,500.
Thank you. Right. Then can you find? No. I think I made a mistake here. Can you find 28%?
$13,860.
$60.
13,860.
Thank you. Then the property, plant and equipment. The admin building, if you can see here, there's no tax allowance. So there will be no deferred tax. So we don't have to include it in the calculation of deferred tax because it's exempt. Right. So we don't have to include that. Just a second. All right. Then the vehicles. Right. Our vehicles, their carrying amount is 1.8. But remember, they said that the schedule above was prepared before the sale of the vehicle was taken into account. So our carrying amount, we have to take this 1.8 and then we deduct the carrying amount of the vehicle. So we'd say delivery vehicles. We'll say our delivery vehicles. Carrying amount. Right, so you take this carrying amount and remove the one which was sold. We know that it had cost 260 and it had accumulated depreciation of 104. So we're going to say 1.8 minus that's 260,000 minus 104,000. What do we get? 1,644,000. Right, then our tax base the vehicles are 1.5. We have to eliminate the tax base of the vehicle. It was purchased on 1 July 2019, so it had been there for 2 years. And we know that SARS are providing 20% per annum, right? So we can calculate the tax base. Tax base of vehicle sold. Cost. That was 260,000. Then we have our accumulated wear and tear. We are told that they were providing 20%. So that is 260,000 times 20%. And it had exactly 2 years when it was sold. Both was bought on 1 July 2019 and then sold on 30 June 2021. So multiplied by 2, what do we get? $104,000. Then we get the tax base. Right, that's 156. So that means the tax base of vehicles, we take the tax base that we are given, which is 1.5, and then we subtract 156,000. What do we get? $1,344,000. So we left 1,344. Then our temporal difference will be this. And can you find 28%? $84,000. Right, it's a liability because the carrying amount of an asset is more than the tax base. Right, so that's what we do. So if there's a sale that had not been recorded, you just have to remove that asset sold at carrying amount. Right, then we have got provision for warranty. It was 106,000 minus the 33,920 that we calculated above. What do we get? $72,080. 0. Can you multiply by 28%? SARS does not account for those provisions. They will only deduct when you actually pay. That's 2182. This one is a contingent liability, so there will be no deferred tax consequences. So that's it. Then we add up. We get our deferred tax liability. Any questions? Right. Then number E, calculate the current tax expense in the statement of profit or loss and other comprehensive income. Right. Calculation of current tax. Right, you start from the profit before tax. Which we calculated on part C, this one here. Right, then we adjust for exemptions. Right, exemptions are all those items that were included in accounting, which are never recognized by SARS. Right, so I will lead, for the sake of time, I will be leading you. Right, on number 1.1, there's the income received from Kenya, which is not taxable in South Africa. This 250,000. So it will be an exemption. So we have our foreign income. Right, exempt income you subtract because it had been added as income, and exempt expenses you add. Right, then we had traffic fines of 25,200. Traffic fines. Add. Right. Then we have sorry, just a second. On the exemptions, there's also the last one is the capital gain. We sold this asset for 270, which was more than the cost. So there's the non-taxable capital gain. Non-taxable capital gain. Right, you take the selling price of 270,000 minus the cost, which is 260,000. So this one will always be there if an asset is sold at more than its original cost price. If an asset is sold at more than its original cost price, what do we get? $2,000. Thank you. Right, then we get our total of our exemptions here. Then we get our profits after exemptions. right? Then we'll have our movement in temporal differences. So we have to find out what was the deferred tax in 2020. All right, so that we can be able to determine our movement. Right, the deferred tax liability on 30 June 2020 amounted to 15,660. Right, and remember that there was tax rate was 29% in 2020. So the deferred tax liability was 15,660. Right. So we're saying let's calculate our movement in temporal differences. Right. A deferred tax liability let me just write. Let's have or let me say temporal differences. Tax. Right. Deferred tax liability 1 July 2020. That is the beginning of the year. Right. Our deferred tax was we are told that the deferred tax liability was 15,660. 15,660. Then to get our temporal differences, we would say 15,660 divided by 0.29, the tax rate. What do we get? $54,000. So we'll have 54,000. Right. Then we'll have deferred tax liability. June 2021, which we calculated here. So that's 77,620 and 21,734. Then we get the net movement. And because our deferred tax liability is increasing, we debit P&L. You look at your direction of movement. So our movement in temporal differences is negative 23,620. Right. So for your movement, you check the temporal differences for this year versus the temporal differences for last year. Right. Then you get your taxable income. Then you get your income tax expense at 28%. Actually, we normally call it a current tax expense. What do we get? $270,021. Right. That's the current tax expense. Any questions? No questions. Okay, so go to the next one. Disclose the income tax expense note, excluding the tax reconciliation. Please, guys, I'm only going to do, I wanted to do also the reconciliation, but because of time, I'm not going to do the reconciliation. So please, at your own time, you can do the reconciliation. Right. Please just go and check in case you're also asked about the reconciliation. Right. Extract of the notes, the financial statements. Of Social Limited for the year ended 30 June 2023. 2021. Right. We'll have income tax expense. Then we'll have major components. Of tax expense. We have current tax expense. Current tax expense is mainly made up of two things. Right. Number one, there is the tax for the current year. Which we have here. What did I get here? Or you only calculate on your own? All right. So we'd say our current year, our tax is this one here. Then you check if there was any under provision or over provision for last year. Any under or over provision for last year is added to the or subtracted from the tax of this year. Over provision, we subtract, under provision, we add. right? If you check from last year, they said that the balance of the income tax payable account in the general ledger of Shosho for the year ended 30 June 2020 amounted to 380. On 10 April 2021, Shosho Limited submitted their income tax return and received a final assessment of an amount of 375, which they had paid in full settlement. So that means there was an over provision of tax of 5,000. So that will be subtracted here. So we'll have over provision would say 380,000 minus 375,000, which is 5,000. Right. Then we also have deferred tax. Right. We have current, and we take the movement in temporary differences, which was 23,620 multiplied by 28%. What do we get? The deferred tax, we calculated it already. This is the 6074 here. So that's 6074, we're debiting it, so we're adding it. And what do we get here? $6,614. Right, thank you. Right, then our tax rate change, the change in tax rates. We take this deferred tax from 2021, the 21,734 multiplied by the change in the rate from 29 to 28%, it was 1. It was 1. So multiply by 1, then we divide by the what? The previous tax rate, which is 29. What do we get? $749. Does it give us this? Something is not right here. Let me just verify. I want to just check what is wrong with these figures. Oh, sorry. The problem is I took 21,373 here instead of the 15. The one for last year was 15,660. Sorry about that. We are supposed to, the rate change, use the one for the last year. So what do we get here? $540. So you see here, it comes out to 6074. That's why I was saying that it was wrong. Right, then we'll have foreign tax paid, if any. Remember, they paid foreign tax in Kenya, which was, they paid foreign taxes of 60,000. So that would be 60,000. Then we add the 3. That would be our income tax note. Any questions? Right. So I want you now at your own time to do this one. Disclose information 5 and 6. That is the provision and the contingent liability. I think that was our previous class. Exactly like what we did in our previous class, you do this provision and also the contingent liability on number 6. In case of any questions, you can be able to, you are free to contact me. Any questions? Right. So I wish you all the best, but in case of any problems, any day before your writing date, feel free to contact me and I can be able to assist with anything. Thank you so much and sorry for disturbing your Sunday. Enjoy your day.